Hey everybody, Corey Mitchell here with TradeThatSwing.com, and in this video we're going to look at 4 things you can do to ramp up your day trading profits. I see the same types of mistakes from a lot of traders, especially new traders. They think they're doing the smart thing, but as you're going to see from some of these examples, they actually kill you. So what we're going to do is look at basically these 4 things. We're going to look at risk. We're going to look at how to utilize your stop loss, which then ties into your profit targets, and then looking at only reasonable profit targets that we're not assuming anything outlandish is going to happen. We can basically trade normal movement and yet still make big profits. And this is where most traders go wrong. They're expecting really big moves and they think that's where the money's made. And we might make more if a really big move happens, but that doesn't have to be the case. In just normal kind of boring markets, we can make killer returns relative to our account size. So the 1% risk rule, I have a separate video on this, which I'll put in the comments. But basically, we're setting a risk amount for ourselves and saying we're willing to risk X amount on a trade. And you could make this 1%, you could make it 0.5%. When you're starting out, I recommend a small amounts, like 0.1% of your account. And then only once you're profitable do you start ramping that up. And you could go up to 2% if you have kind of a smaller account, but you've been successful. The one thing about the approach is when we're risking 1%, positions can get really big, and there might not be enough, shares at that exact moment when you want them. So if you're trading a really large account, there's no real need to go over 1%, and a lot of really large accounts will even trade less than that. But if you're kind of a typical retail trader, you have accounts in the hundreds of dollars up to into the hundreds of thousands of dollars, a 1% risk rule is not a bad place to start from. Once you've shown you're consistent, again, start smaller when you're just starting out. But for example, you have a $45,000 day trading account. If you're willing to risk 1% of your capital on that trade, that means you could lose up to $450 on a trade. That would be 1% of your capital. So that's where I kind of like to sit around there, the 1% risk rule. So I'm willing to risk 1% of my capital on a trade. Now that does not mean that I'm only utilizing $450 of the account. No, I might utilize all 45,000. I might use leverage. I might even be using 150,000, if I have it leveraged up. In Forex, we're definitely using way more capital than we have in the account using leverage. But still, if the price starts to move against us, we have our stop loss, which gets us out for that amount. And there's precautions we can take, not trading right through news announcements, not holding positions, because that could cause the price to snap through our stop loss, causing us to lose more than we want. So we definitely have these little extra rules in place if we're going to be trading large positions. But this is the approach, is we're risking 1% per trade. And again, increase slowly, starting out smaller. So that's just kind of the backbone. That's how we set the precedent. So basically with this example, we have a $45,000 account and we're willing to lose $450 per trade, with the anticipation, of course, that we could potentially make more than that. So we're risking $450 to, let's say, make $900 or $1,350. So the next step then is the one I was talking about, where a lot of new traders go wrong. So they think they're being smart by giving themselves a big stop loss. They're saying, I'm gonna give this trade some room to work, and they just screw themselves. There's no way to get around it. If you do this, you are leaving a ton of money on the table, and we're gonna look at why. So we're going to look at a pro day trader and a novice. We're going to look at a couple examples. So let's just say both the pro and the novice, this is the novice, look at the same trade. They isolate the same entry point. And, so we had this big move up in a stock. It starts pulling back. We can see, it gets a little wicky down here and starts moving up. So they both decide, okay, I'm going long. This is looking really weak pullback. We're starting to move back up. I'm going to go long here. So the novice says to themselves, well, I don't want to get stopped out. So they're buying on this green candle right here. I don't want to get stopped out if this pulls back. So I'm going to put my stop loss way down here. Now, what does that do? If that's how much leeway you're going to give the market, that's going to affect your stop loss. So we have a pretty big risk here. We're willing to risk 450. The stop loss is 78 cents away. So we're buying kind of around here, let's say at 14.30ish, and we're putting the stop loss down here at 13.50, let's call it. So quite a big stop loss there. So to get position size, we take the amount we're willing to risk in stocks, and then you divide it by how much is being risked on the trade in cents or dollars. So this means our novice trader, they can buy 576 shares. So basically what this is saying is if the price were to come down here and hit the stop loss, then they would lose their $450. So this is what a lot of novice traders do, as I was saying. They don't want to lose, so they put their stop loss very far away. And the problem is you're still going to end up losing the same number of trades. Because, price, it could move back here, no problem. But the pro trader isn't as concerned about losing. They know losing trades happen, so they just want to minimize the stop loss, minimize their time in the trade. So this is how I would play this one. If I'm thinking this is a good long and I'm buying in on this green candle, so as the price starts moving above this red one, this is one of my triggers, I start buying in here. I'm putting my stop loss right below that candle, because if it starts dropping again, then I was wrong. My entry point wasn't good. I want to be out of there. So look at the difference in the size of the stop loss. So the novice trader going for the big stop loss, and of course this is just an example. Maybe you would have put yours, somewhere in here. But chances are a lot of people just use a way bigger stop loss than they need to. And we're going to see why that really matters. So here, my stop loss is 25 cents. So now let's go back to the example where we're allowed to lose $450 on a trade. We're trading a $45,000 account. If you knew nothing else about this, the pros only risking 25 cents, which means they can buy 1,800 shares, right? Because if you buy 1,800 shares and you lose 25 cents on it, you're still only losing that $450. Whereas the novice trader, they were willing to risk 78 cents on that trade, which means they can only buy 576 shares. So if you knew nothing else at this point, who do you think makes more money if the price goes up? The pro trader, right? The pro trader has 1,800 shares right here, whereas the novice trader has a lot less because they're basically afraid of losing, so they're putting their stop loss way out there. So they're both risking $450 of their money, yet the pro trader has way more on the line. So how does this then affect our targets? Well, you've probably heard that professional traders, they want to make 2, 3, 4, 5 times their money on the trades they're taking. And if you are using this approach, you might think, wow, that's like, how are they doing that? That's like impossible. Because the stop loss is so big. To make money on this trade, the price has to move up a crazy amount, even just to compensate you once for your risk. So you're risking 450 here. The price has to go up. If you're risking this much, then the price has to go up that much just to compensate you one time. If you're looking at a multiple of 2, 3, 4 times, take this area, stack it. The price would have to get all the way up here just to give you 2 to 1 on your money. Here, at right here, you're making your money back. Here, you're making 2 times your money. Here, you're making 3 times your money. Lots smaller moves to make multiples of your money. And this is exactly what plays out here. So we can see the example. The pro trader, they're only risking 25 cents. They have a lot more shares on the line, but they're risking the same as, a novice trader with a big stop loss. And you can see, so they make 2.5 times their money. And I picked 2.5 because 2.5 is a pretty common target for me. So it was my default in Forex. 2 to 1 is generally my default in stocks. So a 2 to 1 or 2.5 to 1 reward to risk would just be my default. Throw it out there. Maybe I might manage it a little bit after, but that's just my pretty much default throw it out there target. And so you can see here, it hit 2.5 to 1 here. It would have hit the, let's call it the normal 2 to 1 target right here. So we're making 2 to 1 on our money on more shares than the novice trader would. And if we go to the poor novice trader's example, even though they were right about the trade, they never got more profitable than 1 to 1, right? Because their risk was so big that even though this trade did what they wanted, they couldn't gain a bigger profit than they were risking, right? So they were risking $450 here, but giving it 78 cents of room. So that means if the price moves up 78 cents, they can only make $450. And it would have to move up, $1.50 for them to make $900. This guy in a much better position. He can capture smaller moves and still make a big percentage profit on his money. So if we go back to the 1% rule, what does this mean? This means this trader risked 1% of their account with an entry here and a stop loss there, but they made 2% or 2.5% on their money in this case, on their entire account, right? So you're risking 450, and if you had a 2 to 1 reward to risk ratio out there, you made 900 or, just over 1,000 if you went for the 2.5. This trader was risking 450. Maybe they hear that you should have a 2 to 1 reward to risk, 3 to 1, so they just throw it out there. But look at how far the price has to move for that to get hit. Never were they onside more than $450, right? Because this trader could make much more because they had a bigger position size on. So they made 900 while this person never even made 450. You see how that works? And it's kind of reshaping our mind. Most people are so concerned about the risk and they don't want to lose. They give that big stop loss, but by doing so, they basically forego any type of big profit. So stage 4. So you're learning that, okay, maybe a small stop loss is a bit better. That's going to make, then I can risk a multiple, or I can put a target at a multiple of my risk. It's more likely to get hit. But how do we determine if that 2 to 1 target's likely to get hit? In either of these cases, right? So this one, it's way up there, so it's going to be harder to hit than a 2-to-1 target that's much closer with the bigger position size. But, maybe you're not quite convinced yet. So what I always think of in trading is I want to be able to make money in normal, reasonable market movements. I don't want to have to wait for some huge crazy move like this, right? Like this was a really nice move up right off the open. We had the pullback, and this could be whatever chart. This could be a daily chart, a weekly chart. It doesn't really matter. This happens to be a 1-minute chart. But you have a big move like this, and let's say it's a daily chart. The same concept would apply. It's if we put our target a huge amount away because our stop loss is huge, there's less chance that it's going to get hit. So you're just getting like whammied everywhere. You're not going to make as much when it actually does go your direction. So the same concept would apply regardless of the time frame. But how do we know what a reasonable target is? I like to look at normal wave size, kind of what we're seeing recently, because that gives me a barometer of how price waves are moving. So right off the bat here, if we measured this out, and again, this could be a weekly chart, and in this case, it might be a 90% move, or a daily chart, and this might be a 20% move up. But in this case, we had a really strong move up, 9% right in these first few candles that we were eyeballing. Then we get the pullback. So on this next push up, 9% is kind of a ballpark figure, right, for how this stock is moving. I like to be more conservative. So ideally, I want my 2-to-1, maybe even 3-to-1 target. Sometimes I might only go for 1.5-to-1, but I want to be making more. I want to be making a higher multiple on my profit target relative to my risk and still be inside what's typical. So at 9%, I have a 2.5 target up here, and you can see this is probably the price only had to move up maybe 5%, 6% to hit that target. Whereas, I don't have it on here. But yeah, the other guy, he would have had to go up to here, 1620. That would have required, if this is like an 8% move, that's almost double. The price would have had gone up like 15, 16% on this next rally, after the first one only went up 9%. So that seems to me like it's outside of normal market movement. And a lot of traders might say, well, you're only basing it off one wave. If you're swing trading, you can look at the last few waves. When day trading, right at the morning stocks, that first wave is kind of all we have to go off of. That sets a little bit of the tone for the day. And I am not saying that if the first move goes up 9%, then there's a pullback, the next move is going to go up 9%. Actually, I'm kind of saying the opposite. I'm saying don't expect your target, or don't put your target at 9% off this low. Put it at 5%, 6%. Be conservative compared to what you've been seeing already, and then only take the trade if it gives you a good risk reward of 2-to-1 or 3-to-1, or at least kind of 1.5-to-1. If you can do that, look at how you've started to stack the odds in your favor. You're trading within normal movement, what the market's already shown it's moving. Your targets are less than the movement you've been seeing. You're getting a multiple on your money. You have bigger position sizes because your stop loss is smaller compared to the kind of novice trader who's going to put their stop loss way down here. So you're just starting to stack up all these things so that, after 2 or 3 trades, and I saw this at the firm, you have the new traders and you have the experienced traders, and the new traders up just a tiny bit. They were right, maybe even their call, or maybe they ended up losing money. They were right in their call. They took the right trade. They bought when they were supposed to. which again is a skill too. We need those entry skills. But even if you have a great entry, you can still really mess it up and not make that much. So yeah, at the firm, it was basically the difference. You had the guys who really, and girls, who really maximized on their opportunities by, just as I think of it as like, as long as the market's kind of confirming what I'm doing, I'm going to hammer it. And the only way you can really hammer it is if you've really controlled your risk and you're not trading with huge stop losses. Because as soon as you use a huge stop loss, you can't really hammer it because your position sizes get smaller and smaller and smaller. And you're not going to be able to take advantage of any movement that occurs. This was, a pretty decent movement. Went up 6% or so, kind of based on what we could estimate here. Up here was a 9% move. I just drew it in around 9%. This one was 9%. So we can see this next move up was smaller than the first, but it still moved up a nice amount. So we want to be able to capitalize when we're right, and using a small stop loss allows us to hit it with a bigger position size and still capture a good risk reward. And we can do this all markets, stocks, currencies. So this is one here. And you can see just small stop losses. It's like once it starts dropping, I'm going. We had the big drop here, little pullback. The trigger I look for is once I start to see things I like, I'm going to nail it as soon as it, in the case of a short, I'm going to drop. As soon as it drops below a candle low, I'm going to hammer it. So if you watch, drop. Once this pullback starts, we get a green candle. The next green candle does not drop below the prior green candle. The next green candle does not drop below the prior green candle. The next candle, the price drops below it. That's my signal to get in. Simple, tells me, hey, the sellers are coming back in. I give it a second. I'm not like, I wouldn't place an automated order below there. But as soon as I see that selling pressure come in, and it starts to push down below that candle, I'm entering. So that one was a loser. It did move in my favor a little bit. I probably could have cut my loss there a little bit. But once it started going up, because here, same thing, right? I was expecting it to drop, and it pulled back right away, tried to drop again. So this one, based on how I trade today, this was, a few years ago. You will have a little drift, I find, in your trading. Like my trading style does slowly change a little bit based on what I'm seeing, how I'm feeling, how the market's been acting. So this one I would have cut definitely in here. So that one probably would have been about a half hour loss. But then we get the shift, right? So drop makes a slightly lower low, and then we get a slightly higher high here. Pull back, same exact trigger. Starts dropping. A candle high is taken out, in this case for a long, and I'm buying right there where that line is between the red and the green. Small stop loss, and 2.5 to 1. So, in that 2-3 minutes, you're making 2.5% on your account. And yes, you're going to have losses. I have lots of losses. Win, win, win. Couple losses in here, kind of partial ones, a loss there, a loss there. So I actually had a below 100% or a below 50% win rate on this particular day, yet still ended up over 4R or 4% of the account. If you're risking 1% on each one of these trades, 2.5R means you made 2.5% on your account, 2.5% on your account. You lost 1.5%, you lost 1.5%, you made 2.6. So you add all these up, that's 7.5-ish. And we lost 3.5 out of 7. So you're still up 4R, even with losing more than half the trades on this particular day. And none of these targets are outlandish. You can see, like, just based on how the price has been moving, you can see the scale here. Each one of these is about 5 pips. If you're more of a stock trader, you can think of this as like 5 cents, or you could think of it in ticks if you trade futures, anything. It doesn't really matter. This could also be like a weekly chart. The point is that you isolate where you're going to enter. You pick the smallest stop loss that basically proves you wrong, and then it's going to be easier to get a decent profit target if your targets are within typical movement. So on this drop, you can see a drop 5, 10, probably about 15 pips, 15 cents. A lot of these other waves a little bit smaller, right? This one moved 5 plus a little bit here and a little bit on the bottom. This one maybe about 10 pips. So just kind of eyeballing things, moves. This one a little bit smaller, 7, 8 pips. So if your targets are well inside that, ideally kind of 7, 8 pips or less, but maybe they could expand up to a little bit more if you're kind of looking for some of these bigger moves. But all these could easily fit within pretty much any one of these moves. If you just kind of moved one of these around, you can see that target is not hard to hit based on the movement we've been seeing. So hopefully that explains a few things why maybe the risk reward hasn't been as good as you thought it would be, even though you're kind of listening to these things and you're saying, like, I'm putting my stop loss out there, I'm putting my target at 2-to-1, but my win ratio sucks, and I'm just not hitting those the targets aren't getting hit. This can explain why. And then also just being able to capitalize on the movements that the day produces, day in, day out, normal movements, not requiring anything extreme. This is basically one way you can do it. And there are different ways to trade, so of course, take what you like from this and leave the rest. And yeah, you can use leverage, of course. So a few things I just say here in the final word. Yeah, you can definitely, there's assets that don't move as much, so risking 1% or 1% per trade may mean you need to use leverage. In some assets, like the Euro USD doesn't move a lot. It only moves about 1% the entire day, whereas crude would move, 5% sometimes or more a day. So you're going to be utilizing a lot of leverage in things that don't move as much. If things move a ton, then your stop loss may be a little bit bigger, but it's still going to be small, right? No matter what we're looking at. So this was a more volatile day, but our stop loss is still going to be smaller. And so utilize leverage if you need, but you want to cap that risk at 1%. Big daily profits are possible even if you're only taking one trade a day, right? You can take your one, set your stop loss, and you can make 2, 3, 4R on that one trade. And it might only last a few minutes. Big profits aren't about putting in loads of screen time. It's about seeing an opportunity and really putting it out there, I guess, in the sense that you're not afraid to lose, because if you're not afraid to lose, then you can put on more risk, or you can put on more size. Your stop loss is still there. You're still capped at only risking 1%. But the bigger that stop loss gets, the smaller the size gets, the more the price has to move to compensate you for that risk. So it's really just about doing that. I recommend, getting a demo account, try this out, start getting comfortable with some of the concepts we have discussed in this article. But those are your 4 steps, and I hope they help you out.